Check my check. All right. Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it, and we'll provide you with both. Before we get started, be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made. All right. Welcome to day 2 of Value Investing 101. This is an introductory series for the month of June. We will be meeting 5 days a week, Monday through Friday at 8 p.m. Eastern. You can join us on Twitch. You can join us on Clubhouse, whatever works for you, as long as you're here. Now, today we are talking about the evolution of value investing. It's a continuation of our more basic session last night that kind of just introduced you to what the concept of value investing is to begin with. Now we're going to talk about some of the innovators, some of the people that made their contribution, that left their stamp on value investing, and how that evolved into what we're currently doing today. Let us begin. So, from deep liquidation to high quality compounders, that is how value investing pretty much transitioned over time. It started with security analysis. This was a 1934 classic. Value investing was essentially codified by Benjamin Graham and David Dodd. This came after the 1929 crash of the stock market. The methodology focused on intrinsic value, the actual worth of a company independent of its stock price. Now, they had a safety principle, buying assets for less than their liquidation value. So When we say liquidation value, we're talking about the book value. We're talking if the company went out of business today, if they went out of business today, what happens is the company then liquidates everything, right? They first pay off the people they owe money to in terms of debt, and then whatever's left is split among the shareholders. Um, One of the most important things that we look at today is that debt. And we didn't look at it a lot back then. There was a lot of things that we didn't look at back then. But now one of the most important things to look at is that debt. Because if you're going to liquidate, is there going to be anything left, right? But Benjamin Graham was a very intelligent guy, and hence why he ended up writing The Intelligent Investor. Um, and, you know, so he managed to focus mainly on companies with positive equity, right? So he would do the calculations himself back then. We have the margin of safety. We discussed this a little bit last night. The buffer to protect against errors or market volatility. So either one that plays out, we want to be protected against that. And well, margin of safety does so. He introduced a character known as Mr. Market, which was a personification of market irrationality. Uh, Basically, he would say, "Hey," he would go on to say, "Hey, listen, you know, when Mr. Market comes knocking, what exactly is it that you're going to do? Right? You bought a company. 3 days later, Mr. Market knocks on your door. Right? And so now the question becomes, would you like to sell your stock? Right? And Mr. Market would then, you know, essentially try to work you into either buying or selling at its own convenience instead of yours. And that was what was really great about how he introduced the market. It was in a way that people could really relate to, and could understand. Even as complex as what he and David Dodd really, brought to the table, because it was something that a lot of people hadn't done yet. So this ends up being one of the first pieces, the security analysis. That this is the actual book, by the way, security analysis. So we're not talking about Intelligent Investor yet. Mr. Market gets introduced into the Intelligent Investor, but security analysis was where it began. Right. So we look at Benjamin Graham as like the dean, they say, right? The father of value investing, focused on hard assets and nets, right? So this minus this, what do we net? What do we have left? Right? Take the assets, subtract the debt. What do we have left? Is the company trading at that value or not? Right? Is it below that price? And he'd like to get a discount on that, and we'll talk a little bit about that in a second. Then we had the guy they call the Sage, and then they eventually started calling him the Oracle of Omaha. He evolved the strategy from what they called cigar butts to buying wonderful businesses. Um, you know, what I liked about Warren Buffett, what I learned about him later on in my journey as a value investor myself, what I really enjoyed about him was that he reminded me of myself. Right? He took what he learned and he looked to improve upon it. He always wanted to improve upon it. And so he eventually learned that Benjamin Graham was actually not doing something in particular that could have saved him a lot of money, a lot of time, a lot of headaches, and would have gotten him a better return. And so Benjamin Graham would be a guy who would go on to have a great career as an investor, but he had many big losses. Warren Buffett had fewer big losses. Then came my guy, the guy that I look at the most. That's Peter Lynch. We call him the practitioner. He popularized growth at a reasonable price, right? He helped retail investors see something different in the market. And let me rephrase that. He helps individual, independent investors see something different in the market, something more tangible, right? Something that you can really see with your own two eyes, clear as day. And he would go on to say, well, you know, if earnings were growing at a certain rate, then our price to earnings should not be any higher than, 1 times that amount. And people would eventually, as we should, evolve that strategy, because as the market continued on, we became more and more of a speculative bunch who we would really put all of what we had into the market as long as it was running, right? And this is where we talked a little bit earlier today about the crowded trade. So Peter Lynch really became the guy that could avoid the crowded trade better than anybody else. He became the guy also that could see the market for what it is. And that same attitude that you see from me out and about on any given day, which is like, hey, it is what it is. The market is doing what the market is doing, and I'm gonna do what I do, but I'm not gonna allow the market to define what that is, right? Um, First came deep value liquidation. Yes, that's right. Essentially, value investing started with digging in the trash. Almost literally. Value investing started with digging in the trash, right? The cigar butt strategy. Um, Early value investing was often synonymous with buying distressed companies for their balance sheet strength rather than their earnings potential. Net nets, buying stocks at 2/3 of their net current asset value, right? Focusing on tangible assets, cash, inventory, property. And then the liquidation value, buying for less than the company would be worth if it shut down today. And the thing about it is that for the most part, you would go on to find most of these companies at the bottom end of the market, at the bottom of the barrel. You had to go digging to find these. And I want you to imagine that back then, there were no real screeners, right? So one tactic would certainly be to look at companies that have just been doing terribly, right, in the stock market. And you would, from looking at those companies that are not doing so well, you would then say, okay, well, out of these companies that are not doing well, who is trading at the lowest value to their um, actual book value, to their net worth? Now, this is the actual price to book value that we talk about on a regular basis. Okay, so this is that. So obviously, we never abandoned the price to book ratio. And if you think about this the way that I think about this year, that means the price to book ratio is really the first to really, put value investing on the map. Right? It's the OG. It's the OG. Right? So now, as we move forward, we get the evolution into, what eventually becomes Berkshire Hathaway. And we have the late, great Charlie Munger. And Warren Buffett, who really put together something that that took us to where we are today. So, as I said, Warren Buffett first said that, hey, I'm realizing that, and he worked for Benjamin Graham, by the way, Warren Buffett. He worked for Benjamin Graham. And a part of his job was reading through financial statements. So why do you think he loves it so much? So, he realized, he said, hey, you know what? I'm realizing that Benjamin Graham is actually not, uh, he's missing a certain step that could change everything. And that was to only consider the companies who had quality balance sheets, only consider the companies who had quality fundamentals, right? And so Warren Buffett changed it from cigar butt investing to buying fair businesses at a wonderful price. All right. So essentially, imagine taking what Benjamin Graham eventually came up with and saying, well, okay, I like the low price to book value, but now I got to make sure that that there's a great price here. So he would go on to start learning how to calculate the value of the company, the true value of the company, using their financial statements. Then in comes Charlie Munger and says, I think you got this backward, Warren Buffett. Really, I think you need the wonderful business at a fair price. Not a fair business at a wonderful price. Right? And this is what I was talking about today, where I said, look, believe it or not, Warren Buffett didn't always require a company to be trading at a significant discount to what he believed the company was worth. Sometimes he was actually willing to make that purchase. Sometimes he was actually willing to make that purchase at that particular value if the business was wonderful enough. And they focused on economic moats, which are sustainable competitive advantages. They focused on pricing power, which was the ability to raise prices without losing customers. And they focused on quality over quantity. So return on invested capital. All right. Then came Peter Lynch, as I mentioned. He brought in the price to earnings growth, which essentially is the price to earnings divided by the expected growth of the company. And so he bridged the gap between growth and value by seeking companies that were growing fast but weren't overpriced in comparison to that growth. Right? And this became one of the best ways to capture value premiums of all time. Right? Um, he identified high growth stocks a lot earlier than some people would have eventually done. And of course, once people realize that they have a company that's trading for less than it should be relative to their growth, they want in. And so that's where I get my style from, of wanting to be in these companies before people actually realize it. I get that from Peter Lynch, believe it or not from Warren Buffett. All right. Um, and Peter Lynch was also another one to say invest in what you know. Right? Use the boots on the ground observation as a signal of value. That would certainly be a um, really great piece of advice for investors, and it still is today. You know, but it's one of the most misunderstood pieces of advice ever in the history of investing, and I guess we could talk about that later. Don't forget to ask the questions. All right. One of the most misunderstood is invest in what you know. Because oftentimes what people do is they think invest in what you know means buy the stock in the company you buy things from. And that couldn't be more wrong. Right? It means invest in what you can understand. Invest in what you actually have knowledge about, that you can determine if the economy was going to crash tomorrow. Do you understand this business enough that you can tell that that level of cyclicality that will occur? Right? Those types of things. Can you truly understand the business? Now, then came, well, I don't want to say then came, but but we also have the Petrosky F score. And this is another one of my favorites here. And he carried on that tradition of using the price to book value, but he added a quantitative system on top of that. Right. And so he said, look, it's very similar to what Warren Buffett did, but in my opinion, a little bit better. See, Warren Buffett is just, to me, the most famous value investor. But there are some guys that actually did better than Warren Buffett. Peter Lynch was one of them. Petrosky was one of them as well. Now, maybe they didn't do as well as he did as far as like wealth, but they did better than him in terms of returns. Right? Warren Buffett averaged 20%. I think Peter Lynch averaged somewhere around 23%. So did Petrosky. Um, the this 9-point criteria here scores a system or grades a system based on profitability, leverage, and operating efficiency. Right? It lets you know whether or not the financial health is improving year over year. Is it getting better or getting worse? It was binary. That was the genius in this particular system to me. And I actually didn't know about this system until I really started building my own. I learned about this much later on, I had already started building a binary system, and I wanted to know, did anybody else have one? And it turns out somebody else did. It was this guy. And, this really encouraged me to keep going and keep building, you know. I knew how to invest. I can't say I knew, how to build a system for investing. I knew how to work models and things of that nature, but um but Petrosky, his influence, you know, gave me that last little push over the top as a value investor to define something that really, you know, um, that really kept a stable and grounded approach to the market. Um, and he was the first guy that I know that could really just bypass value traps like nobody else's business, you know? Um, because his system really focused on improving businesses, right? Because if I have a cheap business that's improving, how long will it stay cheap? That was essentially the question that he answered. And of course, the answer to that question is not long, not very long. Right? If I have a cheap business that's improving, how long will it stay cheap? Not very long. We have Joel Greenblatt. Um, he created what's known as the magic formula. Earnings yield and return on capital. He combined value and quality, right? Um, and his strategy involved buying the top 20 to 30 stocks that rank the highest on both factors simultaneously. Um, and we'll talk about these strategies, by the way. This specific one, I'm going to really show this one to you guys in one of our sessions. It's going to focus specifically on how the magic formula works. This right here is a part of we work this into our system, right? Um, and we really focus on utilizing, instead of earnings yield, free cash flow yield, instead of return on capital, return on invested capital. So again, as I stated, one of the things that really impressed me the most about Warren Buffett was he was very much like myself. He wanted to improve upon what was done in investing before him, and I took on that same task. I wanted to make improvements as well. And so that's what I did. I made improvements by focusing on cash flow over earnings. You see? I think that was one of the biggest flaws in Joel Greenblatt's system, was that he focused on earnings yield. Um, it's a great system though, so make no mistake about that. But then came the playbook, created in 2018, eventually published in the playbook for stock investing in 2026. All right. And we have the guided alpha model that represents the next evolution of value investing by introducing structural analysis that replaces guesswork with evidence. And so this system became the first that actually focused on that. Actually focused on where's the evidence. And the first system, right, the first value investing model that included a fully integrated portfolio management system. Go look around. Go go test the waters, right? No other value investing model really told you how to manage a portfolio. So, that was where we came in with this to really expand on things. Right? We have an automated workflow. We feature a definitive stock grading system, workflow tools, a discount model, and a quarterly review guideline for capital allocation. All that just works in a complete cycle. Right? Um, this is not the first. This is not the first value investing system to work in a cycle. I'll tell you that it's not. Um, the Dogs of the Dow, which was not included in this because the Dogs of the Dow is a little controversial. I love the Dogs of the Dow, but it's a bit controversial because there's not always a consistent performance with that. But the concept is magnifique. I love the concept. Um, you have the the magic formula, which did the same thing. Also worked on a cycle. So the playbook for stock investing and the guided alpha model is not the first system to work on a right on a schedule, right? And we focus on the mechanical reality, right? We built it's built to provide modern investors with this mechanic or the mechanics for surviving the market and for building that wealth, right? That's what the guided alpha model is really about. It's about compounding. Right? It's about compounding. It's about consistently keeping yourself exposed to the best companies, right? Keeping yourself exposed to the best companies um, you know, while having, um, you know, essentially your having your system always looking for other opportunities. We're trying to avoid paying the highest opportunity cost while also taking advantage of the best opportunities. Right? And that's always a great system for compounding wealth. So this is how things evolved over time for the value premium. Right? Like I said, starts off with the price to book. It works its way into, earnings, and then it evolves into the F score and the return on capital. And, after that, it starts to lean more into return on invested capital and price to free cash flow. Now, Buffett was the one that introduced me to return on invested capital. But some odd reason, the investors that came after him maybe ignored that one. I don't know. I don't know. Right? They went to return on capital. I brought return on invested capital back. Right? And so, these different systems, they focus on different things. The focus in early value investing was liquidation and net assets, and then came moats and brands. Right? Then came quantitative systems. And then we were able to take those quantitative models and build that out to start looking forward at valuations. So we have forward valuation models, is how we look at it. And it's a very important time for us as independent investors because, nowadays when opportunities come, they come in a grand way, right? In a major way because the market is always so so hyped up on speculation that when things finally collapse, they collapse in a big way. They collapse very quickly. You get your investments in, and then the recovery is eventually pretty pretty rapid in itself. All right. So this is your timeline. This is your timeline. All right. From Graham to Buffett to Lynch to Petrosky and Greenblatt to Forbes to us to the equity channel to the guided alpha model where we are today. I think it's very possible that we can look back in, you know, uh, 10 to 20 years and this be something that really, people can say, okay, this really was a shift in investing. This was a shift in the narrative. You know, this was moving the moving the scales, right? Tipping things in favor of the independent investor. And I think all of these guys did a great job of shifting things in favor of the independent investor. I really think they did. Like I said, when it comes down to value investing, the one thing that was always missing was, well, but what do I actually do? Right? Um, Once I know how to find a company, once I know how to, you know, figure out what these stocks are worth and so on and so forth, like from a systematic perspective, what do I actually do? The other thing that I think was missing over the years was what actually works. Right? What works? You know, and so that's why a big part of our focus was, identifying the footprints, right? That we could follow and who did it well, not just who did it. You know, I had a conversation the other night, and this common consensus by so many people is that if I look at two people and I can see that one of them has a bigger wallet, most people believe you should follow the guy with the bigger wallet. All right. Um, but um, there's never an understanding of how people got where they are until you can dig deeper into their process, right? And there were just a few people who really did it exceptionally well while protecting themselves better than everybody else ever did over the course of their careers. And, you had people like Jesse Livermore, um, who's written many books, but he actually gained wealth, lost all of his wealth, gained wealth again, and then lost it all again. So you have to be very mindful of what actually works, right? And like I said, not just who did it, but who did it well. So let's get into answering some of your questions. All right. Um, that's it for this particular presentation. Let's talk about it, guys. What's going on? What you got for me?
Well, I guess, can you hear me?
Yes, ma'am.
Great presentation.
Thank you.
It's really well done. I'm going to go back and double check some stuff. But you did want to ask your question. Answer it now, or maybe you can answer it another time. But on the control score,
Yes, ma'am.
and I know we've gone through that in depth before, so this might just be not, falling right now. In terms of like financial health improvement over the last year, how do you determine that? Like, what are you looking at?
Ah, great question. Great question. See, what Petrosky did was he identified several criteria that would go on to really be great predictors of future performance. So, for example, um, is the company currently profitable? Now, maybe that's not, you may look at that and say, well, that's not an improvement over the previous year, but, it maintains the improvement because a lot of companies start off not being profitable, right? So that was one thing. The next thing was, did the profit margins expand? So is margin expansion happening? When you start to dig deeper into the market, you realize that margin expansion leads to a lot of the gains in the market, a lot of it, right? Um, does the company have less debt this year than they had last year, right? Those types of things, Moji, right? Just to give you an idea. And that's coming from three of the categories because there's three categories, right? And and like I said, we're going to be digging into some of these models. So we will be digging into we won't be digging into the cigar butt investing style. We won't be doing that one. Um, but I will talk to you guys about um intrinsic value in the discounted cash flow model of Warren Buffett. I will talk to you guys about the Petrosky F-score model. I will talk to you guys about the magic formula. Okay? So we will talk about these things. And I'm looking forward to that as well. Um, any other questions?
Can we just go over GILD and how you would determine from your model and your process that this price that we see today was a good price to buy in at?
We can definitely do that. Before we get into that, though, let's see if we can kind of stay closer to what we were discussing for now.
There's a question in the chat from Anthony.
Yeah, I'm reading it right now. Mentioned the Petrosky system was binary. What do you mean by that? Also, what is it about a binary system that you find so favorable? Ah, okay. So a a binary system is a essentially a model built to make decision making very easy, right? It was built to make decision making very easy. So, um, you would pretty much have a binary decision tree. It's either yes or no, right? It either is or it isn't. It either has it or it doesn't have it, right? So you might say, for example, does the company have positive free cash flows? If they do not, then the answer is no. If they do, the answer is yes. This is binary. What makes this very favorable for an investor is it takes the guesswork out of things. Right? Now, if you really keep it as simple as that, positive cash flows are good for investors. So if I have a list of things that are known to be good for investors, and I attach a binary decision tree to those things, right? Then when it's all said and done, what ends up happening is I can now say this company's either good because it has mostly yeses, or it's bad because it has mostly nos. Okay? And that's what makes it so favorable. Because I can just count up the yeses and say, this is a great company. Or I can count up the nos and say, yeah, mostly nos, I gotta go. All right? Mostly no, I gotta go. All right? Any other questions?
I had a question about leverage. How do companies using leverage?
How do they use leverage? You're saying?
How would you measure and how do they use
So think of leverage. And so a lot of times they're using what they call operating leverage. Right? So if I come to your bank and I tell you I'm running an operation that can make $10,000 a day, right, Kenneth? What would you be willing to lend me? Right? $100,000 a quarter? Would you give it to me?
if they're making the money? So
Right. So that's what they mean when they say leverage. Right. And like I said, mostly talking about operating leverage, right? I'm leveraging my business and my business model, or I can leverage my capital like we do in the markets, right? So when you buy an options contract, you're leveraging, right? You're getting 100 shares, right? You're getting 100 shares of a company, and you're getting 100 shares of a company, and you're leveraging that to get a better return than you would have otherwise for the same amount of capital. All right. But you also, as all leverage, you also take on the risk that it doesn't work out, right? Talk to me. Go ahead.
I was going to say, so it's with the banks. It's not company to company. It's mostly with the banks and
Yes. Yeah. Right. And I'm assuming you're talking about the Petrosky app score, where right it mentions that one thing he looks at is leverage, right? So when I said Demoji, one of the things he asks is, does the company have less debt than they had last year? So he's saying, is the company using less leverage than they did last year? Right, less or more. So they have what's known as an equity multiple, and this goes right back to Benjamin Graham all over again, right? Right, it goes right back to Benjamin Graham all over again. All right. And yes, Anisha will definitely do that. I got you on that for sure. So we leverage what we call the equity multiple. So um essentially, if I take the total assets and I divide that by my equity, right? What's that multiple look like? If I have $1 million in assets, $500,000 in equity, my equity multiple is 2, right? If next year I still have $1 million in assets, but my equity has increased to, let's say, 600,000, then my equity multiple is now at 1.67. Okay, so that means I reduced my leverage and I'm now doing more internal financing. Um, they have this other way of looking at leverage, called the DuPont. And essentially, this is one of the ways they look at it. Like, how did you generate your returns, Kenneth? How did you generate your returns? Did you generate it by utilizing leverage mostly, or did you generate it by utilizing equity mostly? That's really all they're asking. Okay. No problem. Any other questions before we dive into this company here? Talk to me, Doreen.
Yeah, you gave us a quick list, and I think you're going to be going over it again when you go through the process. But I only captured price to book, ROIC, and there was like two others. There are like four things that you pointed out quickly that would identify as a good business. Do you remember what it was, or when you walk through this stock, we'll do that?
Yeah, we're gonna come back around to that. Yeah.
Yes, but I'm going to ask you to go slowly so that I can capture notes.
I will go as slowly as possible.
Down.
No problemo.
Are you recording this, by the way?
Mm-hmm.
Okay, all right. I was about to say that, and you're right. He's gonna post it. You're gonna post it on YouTube too, right?
Yeah. So the one from last night is gonna be posted to YouTube tomorrow morning, right? And then so basically the uploads will start essentially tomorrow morning. So the one from Monday will be uploaded tomorrow morning. This one will be uploaded the morning after. All right. So what is that? Thursday morning? Yeah, Thursday morning.
Yeah, that's awesome. So I really need to make sure I understand this.
Mm-hmm. Any other questions before we start digging into this company?
Oh, excuse me. The leverage first again.
Mm-hmm.
We could just make sure I understand it. If we were to flip that to the very short term side trading, it would be like saying that most of my gains come from the leverage product like EQQQ versus trading QQQ.
Or just leverage period. Right? But yes. Right?
Okay.
So you're correct. But just think of the leverage itself, period. So all right, think of it like this, right? And I think we discussed this one before. So catch what I'm getting at here, right? All right. I want you guys to imagine. I'm gonna give you guys two scenarios here, right? And then Anisha, you said Gilead, right? GILD, correct?
Yeah, or any. I'm just trying to see the process.
Right. So I'm gonna talk about this again when we go over the GILD. That's why I asked. I'm gonna talk about it again when we go over the GILD. By the way, good evening, Dish. Good evening, Justin. What's going on, guys? What's up, April? What's up, Jared? What's going on, guys? So for those that are joining us for the first time on Clubhouse, if you click the link at the top of the room, you will see it says watch us on Twitch. You can come on over. All right. So Cecil, I'm gonna give you two examples and I want you to pay close attention to this. All right. So first example number one. Right? You and I both trade the NASDAQ. I trade the NASDAQ just as is using the QQQ. No leverage at all. You trade the NASDAQ utilizing the TQQQ. 3 times the leverage. We both walk out of the day with a 5% return. It becomes obvious. One of us had to have done a better job of trading today. Because there's no way to say that one person used leverage, the other person didn't. They both got the same return. Right? So when you think about leverage, you think about risk. the potential loss of capital. That's what you think about. Okay? Now, then if you were to think of it from a company's perspective, let's say one company has an equity multiple of a 3x, right? The other company has an equity multiple of a 1.5x. They both generate the same return on equity. Which company got the better return?
1.5.
1.5. So how quickly you picked up on that? Because it's a very simple concept if explained well, of course, right? So I tried my best to explain it in a manner, but it's a very simple concept nonetheless. You're just saying, am I looking at a company that's using more leverage to generate the same returns or less? Because that's not going to work. All right?
Yes, that's helpful. Thank you.
No problem. Any more questions before we go on to Gilead? If y'all could think of maybe one more company, that would be great. Or you know what? No. I'll actually take you guys to the screener and we'll pick a company from there.
Perfect.
All right. I'll give y'all a few seconds because before we transition, because once we transition from this to go into that, we'll be in a different mode. All right, let me give y'all a few more seconds there to just think through it real quick. See if I got any more questions. I'm listening.
You that's one over. Oh, go ahead.
Yeah, talk to me.
It's me or Anisha.
You.
No, you can go, Justin.
Oh, for investing, right? Uh, oh, like averaging in workout, like which one? Like, uh,
All right. That is an excellent question. Do I value lump sum investing more or dollar cost averaging? I'm always going to go with the evidence, Justin. Right? Remember, that was one of the things that we said about our approach, different than others, is that we go where the evidence takes us. And evidence has been found that lump sum investing actually outperforms dollar cost averaging. So I will always lean more into that. Right? Of course, we're talking about lump sum investing from an informed perspective, not just I got the money, throw it at the market. All right. Where when we talk about lump sum investing, we're not talking about this. Okay. Look, you see that, Jiv? We're not talking about that. That's not lump sum investing. That's throwing money away. Right? Lump sum investing is actually one of the ways of looking at and thinking about smart money investing. Right? Where it's the individual who has a certain amount of knowledge that they can again leverage and they can enter into these positions at a better price than most other people. All right. That's why they do lump sum investing. Any other questions before we move on? All right, let me start pulling Gilead up now. All right, let me go ahead and refresh, seeing as I've had this open for a while. All right, no problem. All right, let's go ahead and run this. Let's give it a second to run. Now, what you guys are looking at right now is our stock analysis tool. It allows people to essentially run the quantitative part of our value investing system without having to go and, use their fingers and toes to count things up. All right. Um, some people say people say it's okay. It's all right. Okay. Now, here's the deal. When it comes down to Gilead here, we are operating in the healthcare segment. Now, most of the time when I make these types of decisions, I already have some type of information, right? That's the one thing I said a second ago when I was answering Justin's question was what? Informed decisions. Informed decisions, right? So, um, one of the things that I already have in my back pocket is an understanding of which areas of the market currently have the which areas of the market currently have um the best relative valuations right now, right? And so we can look at these particular models and we can see how this plays out. Now, this is a more complex system. It's called relative cyclical PE or relative CAPE. And what it essentially does is it takes the average PE ratio of a company, of a sector, over a certain time. So the average for healthcare was 25.77. Right, that was the average. Right, and you can see right here in June of 2025, it was 23.19. Here, it's a 25.77. Right, so over time, this starts to shift. Right. Either way, this is one of the 5 most undervalued sectors in the market. Right. Now, we have a lot of sectors that are undervalued, but they're already on the run. All right. What you can see here is healthcare is a sector that's undervalued, but it hasn't really started running yet. Neither is financials. So lately, you may have noticed that I've been looking a lot at healthcare, financials, and industrials. Well, look at that. Healthcare, financials, industrials. So they've had they've not had their run yet. They've not had their run yet. And so we're looking to see if they can pick up on that. Right? Now, a simpler way to go about something like this. So that's a model that I built. A simpler way would be to go to morningstar.com. Right, and go to stock market valuations. And how you can get there is you can click on here where it says markets, right? And you can see it says market fair value. You click right there. Okay. And then that from here you can start to look at the different sectors. Right. There's basic materials and so on and so forth, right? Healthcare still undervalued by about 4.7%. Industrials is actually a little overvalued by this particular perspective. So, some people may not look at industrials. Technology, which you also saw on the list, was 4.1%. We were looking at real estate recently. This one is actually 6.3%. Okay. That's how much it's undervalued by right now. Who else was on that list? Financial services, undervalued by about 5.4%. So you can see a lot of ones that are on that list, except for industrials, is actually a little undervalued right now. Now, this goes based on the fair value, right? So by this standard, maybe you don't look at industrials, but you can see clearly which areas of the market have the most value right now. You can even say, am I looking for large caps, mid caps, or small caps? Large caps undervalued by 4.8%. All right. Mid caps are actually slightly overvalued right now. Small caps undervalued by 4.7. So in that particular case, large caps and small caps, both of them can play a role. What did my position look like today? I was long NASDAQ and I was long the Russell 2000, large caps and small caps. I was long both of them. Here you can see, right? I make all of my decisions as an informed individual. I don't make random decisions. All right. So we know that healthcare is one of the most undervalued sectors in the market. And we know that the relative strength there is not as strong as in other segments. So they don't have to quite have the momentum. They don't quite have the momentum. Perfectly fine. All right. Perfectly fine. Now come back over here. What we see now, it looks different now that you have the facts, right? Looks different now that you have the facts. So I pull up a company and I have all these facts in the back of my mind. Let me see if y'all can remember what I just said, right? What are some of the most undervalued company sectors in the market? Give me one, Cecily. What you got?
Real estate.
Real estate. Anisha, what you got?
Healthcare.
Healthcare. Okay. Who else? Who else? Who else? Who else? Let's see who's paying attention here. Who's paying attention? Who's paying attention? D'Amica, what you got? Uh-oh. She ain't close to the button. Moji, what you got? Oh, there goes D'Amica.
I'm close to the button. So what's into it? iPad. Switch on one device and the iPad.
Gotcha.
But I was gonna say real estate and healthcare. What was it? I don't know what the other ones were.
No, you only needed one. So healthcare.
And real estate.
Okay. So we got real estate, healthcare, and Alicia, what you got?
Financials.
Financials. Okay. And those are really the ones that we highlighted for the most part, right? So now when you come over here and you're looking at Gilead, what's the first thing that comes to your mind when you see healthcare? Forget all this. Don't even look at none of this down here. Don't look at it. Stop looking. Okay? Don't look at it. Look up here. Stay right here. See where the name is at? Try your best not to look down here at all. Focus right here. What do you see? Healthcare. So what's the first thing that comes to your mind if you pull up a company and it says it's in the healthcare sector? Potentially, there's value premium. The company has to prove that there's value premium. but potentially there's a value premium for us to gain here. Right? Doreen, you with me?
Yes.
All right, double checking. Am I moving too fast?
We're good. We're good.
Oh, we're good. Okay, great. We got our value premium potential here. Right? What's the next thing I want to know? Okay, is it even worth digging into? That's what I want to know next. What do I find out? It's a buy with a favorable outlook. Great. Where does my eyes go next? RSI, 37.98. What's the first thing that comes to my mind when I see buy favorable RSI 37.98? The first thing that comes to my mind is if I can verify these fundamentals are, let's go with Warren Buffett's word, wonderful. And we're also underpriced, keyword, right, Alicia? Keyword of the day. And we're also underpriced. We may have something. Okay?
Right. We're underpriced because the current price and the street value difference. Right now.
Yes. All right, but all right. Oh, don't go on mute. Don't go on mute. Because I'm gonna ask you a quick question now. Yeah. You done unmuted. You might as well stay on mute. Now, let me ask a quick question. Why the street value based on what you see here? Why the street value?
Street value. That's what the analysts evaluated at this point.
Yes. But we've been working on something recently. I've been working on trying to get you guys to memorize a certain like code of operations, order of operations.
Talk. Because I said it during the day.
Help her out, Anisha.
It's if fundamentals are lower than the street value, you would go with the fair value.
Yes.
Fundamentals. Do you remember hearing that, Doreen? No. Okay. If the fundamentals are higher than the street value, then you go with the street value. Okay. All right. Thank you. That's a good to know.
Excellent job, Anisha.
Right here. Okay. So since we've done that, the fair value is the fair value.
Fair value is 201.51 right now. The street value is 134.18.
No, the fundamental is 201.51.
Yeah. Oh, yeah. I meant to say fundamental. I meant to say right.
Okay.
201.51, okay. And the street value is 134.18. Right. Now, why do we do it that way? Let's talk about that. So essentially, we want to go with the premise that we can actually trust the average analyst target. We want to go with that premise. And we can trust it even more if we can check on the value of the company and we can find out that we believe it's worth even more than that. Right? So if we discount the average analyst target and our fundamental value suggests it's worth even more than that, right? Then that means we have the ability to trust the street value. Does that make sense to you guys? Right? But if we discount the average analyst target and our fundamental value says, well, it's worth even less than that, we want them to meet us in the middle. That's fair value. Y'all with me on that? I'm working my way down this thing one piece at a time. All right? So we're willing to meet them in the middle. That's it. Now, then we have the systems that are built into our system. And man, oh man, do I love it. We have the systems that are built into our system. The Petrosky F-score, right? This is a system right here. It works along with the price to book, another system. Those two work together to create one super system of sorts, right? That has high predictive capabilities of future performance. Now, this doesn't have to be a single year of performance. This can be a longer term outlook. All right. This can be a 1 year outlook here. Give me 1 second here, guys. All right. So yes. Um so when it's all said and done, this can be a really great system that can play out here. All right. So we already see that the Petrosky F score, which is above 6, the studies on the Petrosky F score showed that the top 20% of F scores, all right, the top 20% of F scores, um, they tended to outperform the market. They delivered 23% return on average. And that was when we dug into the lowest price to book and found the positive F scores. Okay. So we took the lowest price to book companies in the market. We took the lowest price to book companies in the market. And then we said, which of those has the highest F scores? This is what we would have ended up with, right? A 23% return on average over that study. And it was a 20-year study. Okay. Then came the magic formula. The magic formula gave us earnings yield and return on capital. What did we do? Right? We took a little bit of Buffett, mixed it in with some Greenblatt, and then we ended up with return on invested capital and free cash flow yield. Right? And then that gives us the second system within our system. We're not done yet. We're not done yet. So far, both systems, right? What did I say on Star Trek? These systems are what? What did they say? No, it's not Star Trek. What's your joint?
Why join us on Star Trek?
Yeah, Star Trek. What did they say on Star Trek? Systems what? Systems are a goal. What is it? Yeah, there you go. There you go. Yeah, both systems are going functioning at functioning at optimal performance, right? So you got both of them running really well. These are our two key systems within the system, right? These two right here are key systems within the system. But next we have the S&P 500 itself, right here. The S&P 500 requires positive earnings growth in order to maintain a position in the index, in order to even get a position in the index. So whenever you're finding companies that are not yet in the S&P, this is a great thing to have, right? So we're really working the actual system of the market itself in this regard. We're working the system of the market itself. All right. Give me 1 second, guys. The answer to your question is yes, Cecily. The SP 500 requires that you have the most recent quarter and the most recent period trailing 12 months has to have positive earnings growth. The next system within our system, no problem. The next system within our system is the essentially the component of market share. And we look at that through the lens of sales growth. If a company's sales can be outpacing their competitors, then this is one of the key call signs of a moat, of a competitive advantage, and a growing market share. So we then bake a little bit more of that Buffett ideology into the system yet again. I'll get to that question in a few seconds there. April, I see you there. Next comes the Peter Lynch system, the price to earnings source. You see what we did here now? Now you guys, now that you get a history of value investing, can you see the history built into our system? Isn't that amazing now? Right? See the history here. We bring the Peter Lynch effect in. We go price to earnings growth. Is the company trading at a price that exceeds what we want to pay for their earnings growth? And we try to limit that to 2 times earnings growth. Unlike Peter Lynch, I'm not looking for 1x, I'm looking for less than 2x. But if I can get less than 1x, well, seeing as we're talking about earnings growth right now, April, if I can get that earnings growth, the first question you need to ask yourself, the most important question of all, is can this company sustain that earnings growth? That's question number 1. Okay? Let's go ahead and write that one down. All right? Questions about earnings growth. And that's a great question, by the way, April. Right?
What did you say that you are looking for? Were you talking about that 0.91x or something else?
No. Earnings growth.
The EPS growth.
Yes.
So what did you say about it?
So
you're looking to have it.
First question you got to ask yourself is it sustainable? Can we continue to see growth at that level?
And how do we make that determination?
You make that determination by being realistic, right? If I see 1,000% earnings growth, do I truly believe a company will continue to grow at 1,000%? Yes or no?
No.
Right. So this is more along the lines of what's realistic. Now, the other thing is you can look at, real quick, another thing is you can look at the return on invested capital or the return on equity. And you can match those up to see, right? Because if my return on invested capital is much lower than my growth, then obviously my growth is likely not sustainable. Talk to me, Cecily.
Based on what you just made to Anita as an example, which is much more reason. Could you also look at the 5-year outlook for the sector to see if it's sustainable?
You could if you wanted to. I'll put that a little lower on the list. Actually, the next thing I want to look at is the actual 5-year projection for the company itself. It's the next thing I want to look at.
So you would look at the company and then perhaps compare it to the look for the future.
Well, no. Before we start doing set the comparisons, we need to look internally first.
Okay.
Right. So, because the company could just be outgrowing the sector. right?
True.
And would we fault them for doing so? No, right? You love that, wouldn't you? Right? So before we start going that route, I think this is probably the wrong metric to go set the comparison with, to be honest, either way. But you can still make the comparisons, but I'll be making the comparison on the other end. Are we outgrowing the sector? So that wouldn't be a red flag check, right? If it's outgrowing the sector. If it's undergrowing the sector, that's a red flag. You see? So it's kind of inverse when you start looking at the sector. Now, we already have a few things that we use to check against the sector. Price to book, we check against the sector. Return on invested capital, we check against the sector. Price to free cash flow, we check that against the sector. You see? Sales growth, we check that against the sector. Price to earnings growth, that one's on its own, right? But so we have 4 components we already check against the sector. See what I'm saying?
Yes.
All right. So we don't necessarily go the earnings growth route. Now, for the 5-year projected growth, the next thing you ask yourself there, because notice it's not a part of our system here, but it's still going to be something that's available to you right here. Your growth forecast, 7.45%. 2 things you're going to ask yourself about the 5-year projected growth. All right. Does it support or refute the current growth? Now, what would you say when you look at this? You can see that there's 7.5% projected growth versus 54.5% current growth. So I would argue that the projected growth refutes the current growth. Yes, pretty simple.
Yes.
So we expect a slowdown in growth. That's perfectly fine. All right. The next question is, are we priced well for growth? Are we priced well for growth? Okay. It says here that we are how do I put it? We're projected to grow at 7.45%, but our PVGO percentage is actually a negative 10.9%, which means that we certainly are not priced for growth right now. Everybody with me on that? We're not priced for growth. So that means that even though our future growth refutes our current growth, well, we've already priced in that reality. Now, Alicia, let's get back to today. You ready? Let's talk about it. So we know they're mispriced. That much we know, right? Let me know if you're there.
I'm here.
Okay. So one second. So we know that they are mispriced. And now to see that they don't have any growth baked into the price at all is how we know they're undervalued. You digging that now?
I am. That makes plenty of sense.
Now, this isn't the only way you're going to find that out. This is not the only way you're going to find that out. There's other ways I could have figured that out because sometimes there will be growth baked into the price, right? But maybe they're just trading well below the street value or the fair value, and they're at 20 on the RSI. Right? I would argue at that point the market may certainly be undervaluing them. Right? This is a more definitive undervaluation right here. That's a more definitive undervaluation. So we'll look forward to seeing how that plays out. So April, those are the key questions that you want to ask around earnings. Is it sustainable? Does the 5-year growth forecast support the current growth or refute it? And are we priced for that growth? Those are the 3 most important things you want to ask yourself. Cecily.
I was going to ask, because I've asked you this before, but this is giving me, I think, some better understanding. How do you determine something that's overvalued versus deep value mispriced?
So if we say deep value mispriced, that automatically suggests undervaluation. Well, so let's start with that.
What you would consider the deep value?
No, yeah, this isn't deep value underpriced. Well, I mean, you're talking about having upside that goes years ahead of your expected return, right? So if my expected return is, let's say, 15%, for example, right? And I have a 30 to 45% discount to the price I believe it's actually worth right now, then I can argue we have deep value. All right? We're nowhere near that right now. Not even close. All right? I mean, we're 10% below the no growth value. So I mean, that's reasonable, That's reasonable. But how much below the fair value are we actually? If we go from the fundamental perspective, then sure, you might say deep value. Make sense?
Yeah.
But we're not currently utilizing fundamental value, are we? So it has to be off of this or this, because these are both margin of safety. So we go so far beyond a margin of safety that it's you have to start. Like typically when there's that deep of value, you have to start questioning whether or not it's real. Let's put it like that. Like if you're not questioning it, it ain't deep value. How about that? All right? If you're not saying something has to be wrong here, then it ain't deep value.
Well, yeah, because I'm like deep value or cheap for a reason.
Right. So typically I have questions of deep value. I'm still gonna buy it, of course. But I know. See, the thing about deep value is it appears to be the lowest risk you can take, right? Wrong freaking answer. Right? Deep value is probably going to be a greater risk than this right here. Right? Because how'd you get down there? I'm sure it wasn't from good things. Right? Keep that in mind. So if we continue on here, we then move on to, you then move on to the quality of earnings, right? Then move on to the quality of earnings. Shout out to is that G Thanker? Shout out to G Thanker for the follow, much appreciated. The tracker has it ranked at a number 2. Thank you, Anisha. So okay, Let's keep going here, right? So now we can see the quality of earnings. And this right here really is a call sign of a quality business. All right. When they generate more cash than they report in earnings. All right. So they reported, let's say for every dollar they reported in earnings, they reported $1.12 in cash. All right. So imagine that. I repeat, for every dollar they reported in earnings, they reported $1.12 in cash. All right. Now, if you're joining us for the first time on Clubhouse, or if you're here on Clubhouse right now and you want to know, well, why does it seem like this guy is showing people something? That's because I am. If you click the link at the top of the room and you hit watch us on Twitch, you'll be able to see what I'm showing these guys. All right. So the quality of earnings is really excellent. This is excellent quality. All right. So I typically don't require anything, like for every dollar I require maybe 70 cents. Right. Now, then we have the debt to free cash flow. And what I want to know is with that same free cash flow that's backing up these earnings, could I pay my debt off in less than 5 years? I repeat, with that same cash flow that's backing up my earnings, that same cash flow that I'm currently paying for here, this price to free cash flow right here. With that same cash flow, can I pay my debt off in less than 5 years, or 5 years or less? If the answer to that question is yes, then I have a business that I do not believe is over leveraged. Okay? I don't believe that any business that can cover their debts in a 5-year span with um with free cash flow alone, just cold hard cash. I don't believe a business is ever over leveraged if they can pull that off. Right? But once they start to go beyond that point, I start to question whether or not they, you know, they're really thinking about things in the long run. Now, some companies are going to naturally be more than 5 years leveraged. That's because they're usually like infrastructure companies. They sign like 30-year deals, 20-year deals, and stuff like that. They'll take out really long-term loans. So that much I'm fine with sometimes, but they have to have all the other qualities to go along with it. And last but not least in our system, we have relative strength. This is this plays a role in our outlook. And our outlook is built off of the F score, the price to book, return on invested capital, the price to free cash flow, right? The quality of earnings, and the relative strength. Right? So one system, two systems, right? Quality of earnings, and your third system here. Relative strength is another system within the system. All right. So if this relative strength was at least a 0.9, which means that they're performing in line with the market, then they would get a 1. It's not, so they get a 0. They could do better on that performance. All right. So right out the gate, I'm seeing a company that is showing me 90% of the qualities that I need to see. And the only two things that are missing is the stock performing a little bit better and the price to earnings relative to the growth could be a little bit better as well. All right. But I'm getting the price to free cash flow and the price to book. So on valuations front, I have 3 valuation points for a reason. I actually did that on purpose. All right. So I'm scoring 2 out of 3 on valuations. So price to earnings growth, you are overruled. See what I just did there? With me on that, Anisha? See what I just did? All right.
Mm-hmm.
I put 3 there for a reason. So you have the power of 3 here. So when one disagrees, if the other 2 agrees, the 1 is overruled. Okay? Because these are 3 extremely powerful valuation points. All that came from, like throughout history of value investing. Price to book with Benjamin Graham, free cash flow with Warren Buffett, price earnings growth with Peter Lynch. You put all 3 of them together. So that's like saying Buffett and Benjamin Graham agree that this company is underpriced. So Peter Lynch, you're overruled. So see how that works? See when you think of it from that perspective? That sounds reasonable, right? Sounds pretty reasonable. Now, our system here comes with an AI model built into it. All right, comes with an AI model built into it. If you are present on Clubhouse, you can click the link at the top of the room, and you'll see it has a link there that says stock analysis tool, and that's where this tool is at. It has an AI model built into it, and you can actually use that to analyze the company here, right? So I'm focusing mainly on the quant thesis and the red flags, right? So we already know that the revenue and the earnings growth are having a bit of a disconnect there. We talked about that already. So we've already addressed that concern. The asset premium versus the intangible risk, right? So this particular part of our system has already been proven to have. It's already been proven that this part of our system is approved. So this risk has already been addressed. The efficiency trap, return on invested capital versus the debt to free cash flow of 2.17. This part of our system has already verified that this risk is already addressed. Notice all the risks have already been addressed within our system already. See that? Okay. What else we got here? So they're doing some they need some FDA approvals here. This is always a risk with these types of companies. There's nothing you're going to be able to do to look away from these risks here. Market concentration in rare diseases. So they have to do better at diversifying their revenue stream as a company. Okay. Good evening, Morpheus. Good evening, Janet. Good evening, IQ. Kendall, Sean, Jose. Good evening, everybody. All right. Catch you in the morning, Anisha. All right. So then we have the earnings distribution trap right here. So, this goes right back to the same thing. It's 54% earnings growth here versus the 3% growth there. So pretty much all of these things have already been addressed. And so see, it says no severe insolvency red flags, right? But high risk of valuation correction, which again, we've already overruled that particular objection, right? So no need to be concerned here at all. All right. We're going to stick with there's no severe insolvency red flags. That's the part that we're running with here. All right. So all in all, when I look at the company, right, I see a stock that's undervalued in a sector that's undervalued. Also, this particular sector is known to be a go-to sector if the market starts to fold, if the economy starts to fold. So could we possibly end up running to this particular company? Is that possible? All right. And I think the answer is yes. I think this could end up being a safe haven play in the long run when people need somewhere to go with their money, and when we need some value premium, we're gonna start to dig into these sectors that are still a little undervalued, and that's why the tech sector continues to run as well. There's still some value premium in the tech sector, right? So but that value premium in the tech sector is more based on um, extremely high growth projections than an actual discounted premium. All right. So that's going to be one of the main things that you want to keep in mind. So I would much rather dig and find something in healthcare than in technology right now. All right. Does anybody have any questions here? All right. If you show up in the morning, all right, tomorrow morning, I will actually I'm gonna do a full screener with you guys in the morning. I'm writing it down right now. So I'm gonna do a full screener with you guys in the morning, and we'll go over some companies from there where we do the same analysis. We'll break it down from that perspective. All right. In fact, I want to look at one more thing with Gilead in the morning as well. I'll show you how to actually do a comparative analysis. Who asked about the leverage? Was that Kenneth or Cecily? Which one of y'all asked about that? Or was that both of y'all? Yeah, I think both of you guys asked something about that. So in the morning, I'm going to show you how to do a comparative analysis of leverage and return on equity. All right.
Nice, thank you.
All right. So you'll be able to say, okay, cool. Which company has the better multiple, or which company has the better return on equity? All right. So it's going to be the DuPont model. You're familiar with the DuPont, Cecily? We've done the DuPont model before.
Yes, we have. So I'm new to the room. When you say in the morning, what time are you speaking?
Yeah. So tomorrow, 9 a.m. All right. You guys show up tomorrow at 9 a.m. We usually open the room at Eastern time. We usually open the room at 9 a.m. We start the stream at 9:15. We start analyzing companies around 10 a.m. All right. And that's if we don't get any trades. But if there's a trade going on in the morning, we'll probably start analyzing companies by maybe 10:30, 11. All right. Because if there's a trade open, we want to get our trades in first. All right. But it's always some good times. We're always here and working on things in that way. As I mentioned, if you want to get a copy of this stock analysis tool, you click the link at the top of the room. You'll see it says stock analysis tool, and you'll be able to, do anything you saw me doing tonight. But also, these replays will be uploaded to YouTube. This particular replay will be uploaded on Thursday. Last night's class will be uploaded tomorrow morning. All right. Last night's class will be uploaded tomorrow morning. This class will be uploaded on Thursday morning. All right. I'm going to have an entire watch list on YouTube for you guys. There's also a Telegram group that's in that link. You might want to join that Telegram so that way when I share the link to the YouTube channel, the playlist, you get that playlist there. I mean, you can just follow pretty much everything that's in that. There's a YouTube channel in there. There's a Telegram in there. I'm gonna leave the room open for a little bit, so you guys can kind of follow some of those, some of those links. All right, follow the Twitch, follow the YouTube, follow the Telegram. All right, I'll leave the room open for a little bit. But once I upload the first video, I'm gonna start an actual. I'm gonna start an actual YouTube playlist or watch list that's going to have the Value Investing 101 attached to it. All right. So keep that in mind. So I'm gonna when I finally do that, if you've already subscribed to the YouTube, you can hit the notifications and see if they notify you that I uploaded that. Maybe you can check my page to see if you find the watch list or whatever. Otherwise, I'm gonna make sure I share the watch list in the Telegram for you guys, so that way you can follow the watch list and you be able to check that every day. I'm also gonna have that watch list available on the Twitch page later on down the line. Once all this is done, so after June, sometimes I'm actually going to load up the the Twitch, and I'm just going to play random videos from the course from time to time that you guys can actually watch. All right, so it's going to be pretty dope. The same way I play those educational videos there as well. Or I might just add it to those videos, huh? Might add it in there, and maybe catch one of these every once in a while as one of the videos that'll play out. So I'll probably do that instead. All right. Well, I'll leave it open for another 3 minutes. Give you guys an opportunity to, like I said, to follow those pages. On a scale of 1 to 10, how much information did you get to soak in tonight?
10, the last two sections of the intense.
Okay.
Great, only because there's just so much information, but it's really good. So I'm going to go back and look at the replay, but it was an excellent section.
Nice. Thank you. Cecily says a 9. All right. Okay, we throwing 8s and 9s out there. This was a slam dunk contest, I almost beat Dominique. You know what I'm saying? What?
You are doing so well.
What? I'm just saying,
You're channeling your inner Tia right now.
this is a slam dunk contest. I'm one dunk behind Vince Carter, man. That's all I'm saying. It's all right. People with dreads are known to hate.
You don't have to be drilling.
Goodness, I learned that from the beret committee.
Like that's the emoji. You're welcome.
Let what
Very welcome.
let what stand? I didn't even say nothing.
So, appreciate it. Good night, guys. I'll see you tomorrow morning.
Good night.
Good night. Good night.
What's up, Donna? Donna, I sent you a message. So, and Donna, in my profile, my phone number's in my profile. Send me a text message when you get a chance, Donna. Okay? Just so I can lock your number in, and then we'll we can at least message there, because I take a long time to answer those Clubhouse messages sometimes, because when those morning rooms end, I'm like, I'm out of there. So then I come back on Clubhouse, and I go straight to starting another room, and then it takes me like a couple days where I'm like, wait a minute, let me check my message. That little blue dot that be on the messages thing, Yeah, there's a little blue dot there. You know, yeah, they need to do better with showing you your messages, though.
At least you answer yours.
Yeah. Oh, yeah. No, I answer all of them though. That much I do. I answer all of them, but sometimes they take days to answer them. That's the problem. So, all right, guys. Well, I did enjoy tonight's session as well. I really did enjoy it. I really liked going through the history of value investing and working our way into what we're doing today, and how we combined all of those different systems of the past to build what we look at as the system of the future. All right.
And the wonderful fact that we are participating in the system of the future.
Yes.
I love it.
You helped build it. Don't forget that. All right. If not for y'all, I might still be working on it in 5 years. Right? But you guys helped me prove that it works. That's what mattered the most. So I appreciate you guys for that. For giving me a chance. I mean, you could have just said, screw you, there's Buffett, You could have said that. Right. You could have said, screw you, I'm going for the cigar butts. You could have said that, but you gave me a shot. And I really do appreciate that, guys, because I'm not sure how confident I would be in the system if I didn't see it work for so many people. Right? In fact, I've not seen the system fail for anybody yet. You let me know if you're running this system and you got a negative return. You let me know. Because we need that in the case study if that's the case, huh? We can't do a case study without those negative returns. But I haven't heard of a negative return yet. So that is a beautiful thing. All right, guys. I'll see y'all in the morning.
Thank you so much. Good night.
9 a.m. sharp. Later.
Okay.